Welcome back everyone as we head into October, historically the most volatile month for the markets, and we've already seen that. In fact, signs of the S&P trading mixed just yesterday as well as over the last few days. And what makes today's episode especially important is there a clear divergence in behavior over the past 4 weeks. Institutions and hedge funds have been selling while retail investors have continued to buy, and that's pretty much a trend we have continued to see throughout the majority of 2025. Now, even being in a government shutdown on currently day 3, most stocks continue to keep pushing to all-time highs, and in fact, historically, that's not unusual. Markets have often climbed even during past shutdowns, but this time AI remains the main driver of capital spending, not just in the US but also in China. And now we have Morgan Stanley warning that cracks may be forming in the capex boom story. Now, interestingly, despite markets sitting at all-time high, overall investor sentiment is still firmly in neutral, which creates a fascinating setup heading into earnings season. And today we're going to break down 7 stocks near 52-week lows that could offer opportunity in this environment. So jumping straight into stock number 1, where we're also going to give you our own valuation for each company, the margin of safety as well. We have Coca-Cola down 7% in the last year. Year to date, it's up around 6%. Over the last 10, up around 57%, and has marginally underperformed the S&P. Now, it is trading towards the lower end of the 52-week range. Whilst we only get one buy rating, that is from Wall Street, 4.44. This is very near the 4.5 to flip it into a strong buy rating, so Wall Street conviction is very high. If we talk about the valuation on a forward P, it comes in at 21, which is below the historical average at 24, so in one way an undervaluation signal, although bear in mind we don't look at this purely in isolation. Yield 3.1, not too dissimilar from the average at 3. And when we do take a look at the blue tunnel, which as always highlights the intrinsic value within the parameters, it is sitting just at that bottom end, so a potential undervaluation signal. Although for the majority of the last year, it has been trading well within the blue tunnel. When we do zoom out to the last 10 years, firstly, great to see upward trajectory continuing to climb higher from a fair value perspective. But again, it is a company, very rare to see it in a severe undervaluation. That is where we get it below even the bottom end. Quite significant disparity, so maybe one to consider. That is definitely something Wall Street believe. Now, the dividend safety score, which we will look at for these companies, sits at 80 safe. Very important, especially as some stocks we'll cover today have massive divergence from their 5-year average. And if we look at their most recent growth, which was at the beginning of the year, 5.2%, slightly above the 4% historical inflation rate, that is something we see over the last 5 years as well as over the last 10. In terms of the number of years, well, Coca-Cola is in fact a dividend king, 50 plus years of consecutively increasing the dividend whilst paying a dividend for the last 105 without a reduction. And then when we move to the valuation grading, they do get a D-, pretty much highlighting they trade at a premium against the sector of around 39%, but as we did just pinpoint minutes ago, this one trades at a discount to their 5-year average. And we can have a quick look at what the institutions themselves are doing with each of these stocks. As we highlighted, the majority of companies today, institutions and hedge funds are selling. So Coca-Cola, 71% ownership, 18 billion worth of sales in just the last year. A lot more buying at 28 billion, around twice as much buying in Q3, so they're in fact net buyers. And we see the same trend quite consistently. If you wanted the reversal, you would have to go to Q3 2023. Now, as we said at the beginning, each one we're going to give you our intrinsic price, where for Coca-Cola it comes to $72, purely the average of the 3 models that you see on screen. And when we do our deeper dive, we do cover each one. The only thing we will go into a bit of depth is the DCF model. Now, it does come in lower at $65, where we've used a growth rate in line with analysts at 12%, which is pretty much roughly what is baked in to the future free cash flow today at 12.2%. Always a good gauge just to look at this, because ultimately if you believe it should be lower, then potentially overvalued. If you believe it should be higher, potentially undervaluation. Now $71, the average of the three, and as always you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Coca-Cola or any others. Now typically we like to kick off at 10%, execute and buy if it meets our three golden criteria: wide moat, strong financial metrics, good forward-looking data. Now that tells us it's a buy at $64 based on a 10% MOS. Already baked in, if you're adding today, is an 8% margin of safety. Some people like to buy this company at even a premium at fair value or even a 10% MOS, which it isn't far off today. For those that want a 20%, a buy at $57, and at $25, $54. Wall Street themselves, as we said at the beginning, a very, very near strong buy rating. $80 is where they see this into 2026 with upside of 21%. So let us know on stock number one, Coca-Cola, is it a buy, hold or avoid? Before we continue, we want to let you know we have released our latest free weekly article. We draw one every single Sunday morning to your inbox, covering severely undervalued stocks as well as what's going in the markets over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to a recently released copy of severely undervalued stocks for the month of October. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're looking at is McDonald's, down 1% over the last year. Year to date up around 3.5%. Over the last 10 years, unlike Coca-Cola, has outperformed the S&P 500, trading near 52-week lows with a double buy from Wall Street and Quant, Seeking Alpha giving this a hold. Now valuation, also like Coca-Cola, forward P lower 23 against their 5-year average at 25, whilst also offering a very marginally high yield, 2.4 versus 2.3, and does look like the mirror image where we get to see it pretty much trading in its fair value over the last year. At the moment it is sitting right there towards the bottom, again potential undervaluation, where if we zoom out to the last 10 years, incredibly rare to see this severely undervalued. You'd have to go to around 2024 where we did see it on 2 occasions. Other than that, you would have to go before 2016. Dividend safety also looking good, 77 safe, where their last increase was 6%, so we should be anticipating one very, very soon, perhaps in the coming days. Over the last 5 and the last 10 years, they've been increasing it on average at 7.5%, and very near, we're talking 2 years away from becoming a dividend king, 48 years of consecutive increases. Valuation, they also get a D, but bear in mind some investors do believe the likes of Coca-Cola and McDonald's, given their brand recognition and overall fundamentals, do deserve a premium. That is something we see against the sector at 34%, and again we just highlighted a very marginal discount, 6% to their 5-year average. Institutions, 70% ownership, 11 billion selling, more than double that buys at 25 billion, and again more than double the buys in Q3. Net buys pretty consistently in 2025, and if you wanted the reverse of the trend, well, very marginally in Q2 2024, one that in fact more often than not institutions are buying significantly. Now our price, $321, where in fact DCF does come in lower at $255. We notice here we've used an 11% growth rate, again in line with analysts. Reverse DCF does sit higher at 12.4. But again, by using the average at $321, you are getting today a 7% margin of safety. If you wanted 10%, a buy at 289, at 20 at 257, and at 25 $241. Wall Street with their buy rating $340 into next year, 14% upside. Let us know your views on McDonald's. Is it a buy, hold, or in fact one to completely avoid? We then move on to ADP, automatic data processing, up 2% in the last year. Year to date, pretty much flat. Over the last 10 years though, outperforming the S&P, trading near 52-week lows, just one buy rating, in fact from Seeking Alpha today at 3.75, where we get another forward PE, 26.5, below the average at 29, another yield with only marginal disparity at 2.1 above historic 2, and very similar to the two previous companies within the intrinsic value over the last year. As of today, sitting right there towards the bottom. And when we zoom out to the last 10 years, you can already tell these are quality companies, or at least have historically been, because it's very, very rare to see them in a severe undervalued play. Dividend safety, not safe. We get very safe at 97, always great to see. And double-digit increases is the name of the game for ADP. 10% last November, so another one on the cards very soon. 11% over the last 5, 12% over the last 10 years on average, and another recent dividend king, 51 years of consecutive increases. We also noticed the company, like the previous two, trading at a premium to the sector of 26%, but a fairly marginal discount of 10 to their own historical figures, where institutions with their 80% ownership sold $8 billion, they bought pretty much bang on twice as much. However, first one today where we actually notice more selling than buying, which actually goes against the trend for quite some time. If you wanted to see another instance where they sold more than they did buy, you'd have to go before Q3 of 2022. Now, intrinsically, we get $327, actually the opposite to what we saw from the prior two, where the DCF does come in higher, $379. We've used 10%, lower than both the average, lower than analyst expectations, lower than the most recent, so maybe you could argue this is conservative. Baked in is 6.2%. Now, using all three, you are still getting a margin of safety of 12%. If you wanted more at 20, a buy at 262, and at 25, $245. Wall Street themselves see this at 322 into next year, 11% upside. Automatic data processing is at a buy, hold, or avoid. We then move on to waste management, up 5% in the last year. Year to date, up around 8%. Over the last 10, massive outperformer, up more than 300%, trading near 52-week lows, where we get a double buy from Wall Street and Seeking Alpha. We do, however, notice on both accounts, forward PE and the yield not too dissimilar from their averages, so potentially a reasonable signal, and that is what we get when we look at the blue tunnel, pretty much again for the last year, trading well within the upper and lower end. When we zoom out to the last 10, in fact, this is one that is very rare to see, if at all, over the last 10 years in a severely undervalued play, which is why we always say make sure you're subscribed, notification bell is on. When we see high quality companies severely undervalued, we will make you aware. A nice 80 safe on the dividend score, where the latest increase was 10% in December 24, 8% over the last 5, 7 over the last 10 years, and they've been increasing it for the last 21 years consecutively, meaning they're 4 years away from becoming a dividend aristocrat. Another one where it trades above the sector at 36%, as we said, pretty much in line with their average, -1%. And Wall Street, with their 81% ownership, sold $7 billion, bought nearly twice as much, and they also bought pretty much twice as much in the most recent quarter. If you want to see the reverse of the trend, well, you would have to go back quite some way, really highlighting that this is one institutions very, very bullish on, and for quite some time. Now, our intrinsic value at $207 is quite interesting because it actually flags as of today it's trading at a 4% premium, but we notice with the multiples valuation and the DDM, on average it sits at 240. The DCF really does drag it down, $142. And whilst we've 12% growth rate moving forwards, again lower than the most recent year, baked in on this is 16.4%. Could tell you, as we highlighted, this one does not really trade at a severely undervalued level. In fact, it is hard to pinpoint that over the last 10 years. Now, if you want to use all three models, if not, it's about $240, but using all three, a 10% MOS would be a buy at 187, at 20%, 166, and 25, 155. Wall Street, though, very bullish, $263 into 26, 22% upside. Let us know your views on waste management overall. We then move into the railroad industry. CNI, Canadian National Railway, down 19% in the last year, down 7% year to date. Over the last 10, not the greatest, up 52, but pretty much trading right there next to its 52-week low, with a double buy from Seeking Alpha and Wall Street, where the forward P sits at 17, one of the lowest in the last 5 years, with the average at 21, yield one of the highest, 2.8, well above historical 1.96, and we get to see it actually below the bottom end of the blue tunnel. This is where we would get our undervalued signal. And zooming out over the last 10 years, again, companies so far that we're looking at have never really been trading for a long time in a severely or in fact undervalued position. That is what we are now seeing with CNI, and great to see another very safe score, 97, where increase at the beginning of the year was 5%, but historically they have offered double-digit increases, 13% on average over the last 10 years, and they're a dividend aristocrat with 25 plus years of consecutive increases. Now, for the first time today, this is one that actually trades at a discount to the sector. We're talking 17%, also a discount as highlighted to their 5-year of 20, and institutions 81% ownership, selling 5 billion, buying near enough 7. And in Q3 we didn't really see too much movement, barely any selling but no buying. In Q2 and Q1 though, and in fact in Q4, we noticed institutions have been heavily adding. Now, intrinsic value $107. Again, DCF comes in lower at 94, where we've used 10% moving forwards. That is pretty much what is baked in today, but overall 107 gives rise to a 12% MOS. At 20, a buy at $86. At 25, we get to 80. Now, in terms of Wall Street, $115 into next year, 22% upside. Also an attractive and safe dividend where we do get fairly decent increases. Is CNI one on your radar? Maybe you prefer others in the industry, UNP or CP? Do let us know. We then move on to Domino's Pizza, up 2% in the last year, up 3% year to date. Nice outperformance over the last 10, above 300%. Where it's trading near 52-week lows, just one respectable buy rating from Wall Street today, and we get a forward P 24 below historic 27, yield slightly higher 1.6 versus 1.2, as well as an undervaluation signal just below the bottom end, something we have seen a few times in the last 12 months, of which when we zoom out to the last 10 years, again, unlike the previous ones where it was very rare to see, with Domino's Pizza, you do get quite a lot of opportunities to consider adding in an undervalued space. Now, the first one where we actually get a borderline dividend safety score at 55, which we will touch upon, but this is one that historically has offered very large increases. We're talking 20% on average year after year over the last 10 years, whilst increasing it over the last 11. But two things to consider when we do see a company with a borderline safe score. Firstly, free cash flow payout below 50% is preference for the industry, gives us faith they can continue to offer what they have historically done, nice double digit. Below every single year, 36 on a trailing 12 month, 40 over the next year expected, so no worries from this perspective at all. But the issue lies when we look at the net debt to EBITDA. We want below 3.5 for the industry. Now, numbers you see below are the number of years it would take DPZ to pay off all of their debt net of cash on hand, and correlates to not just dividend safety but balance sheet strength. Great to see from the highs of 2022 at 5.6 is continued to climb down, 4.54, expected to come down again over the next year, 4.26. So this is why we get the borderline safe score, just something we would say to bear in mind, but nice to see the decreasing nature. They're also trading at a premium to the sector of 35%, whilst as highlighted a discount to their 5-year of 16. Very high institutional ownership, 95%, 2.4 billion selling, nearly twice as much buying, and in fact we just get buys in Q3. This one, more often than not, institutions are buying heavily. You'd have to go to Q3, the only time in this in fact time frame where they did sell more than they did buy. Now, intrinsic value $515. DCF comes in quite lower. We've used a growth rate of 12%, where in fact baked in today is slightly higher at 12.3. On average though, you are getting a 16% margin of safety. If you wanted 20%, well, a buy at 412 at 25,386. And we notice into next year, Wall Street see 21% upside, price target $520. Is this one that is on your watch list? Do let us know. We then move on to Texas Roadhouse, which is down 7% in the last year. Year to date, down 9%. Over the last 10 though, it has outperformed, up 334%. Trading near 52-week lows, we do get a double buy, although fairly weak, from Seeking Alpha and Wall Street, where the forward P only marginally lower than historic, 23 versus 25, yield 1.7, historically slightly higher at 1.8, and this has been a common trend today where most of the companies these are sitting right there towards the lower end of the blue tunnel. Not something we've seen that often, in fact just once during Liberation Day in the last year. Zooming out to the last 10 though, there have been some times where investors could consider this at that undervalued signal. Now dividend safety coming in at 80 safe, where we notice double digit 12% just this year, 15 over the last 5, 15 over the last 10, and they've been increasing those dividends for the last 4 years and paying one for the same time without a reduction. Now you are paying a 39% premium for this company against the sector, but as highlighted, a 26% discount to their historical numbers. Where high institutional ownership, 95%, 1.8 billion worth of sales, twice as much in terms of the buyers. Very minimal movement in the most recent quarter, but again, over the last few, in the more recent period, institutions have only been buying more and more every single quarter. Now our intrinsic price, $190, and perhaps for the first time today, we actually see the DCF not too far off, where we've used a growth rate of 10%. Baked in today is 7.9. On average though, we are looking at a 13% margin of safety. 20% gives rise to a buy at 152, at 25, $142. Wall Street, bang on $200 on average into the next year, 21% upside. Let us know your views on Texas Roadhouse as well as the others today. Are they a buy, hold, avoid, or maybe one of those to consider putting on the watch list? Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.